So once again, good evening, everyone, and I wish you a very happy New Year. I hope that 2023 is going to be even much better than 2022. Personally, health-wise, wealth-wise, happiness-wise, I'm sure that this year brings a lot of positivity amongst everyone. My name is Yogesh, and today's topic we are going to talk about is exploring investment opportunities and evaluating risk in 2023 in financial markets. Before I even begin this session, please check if your chat options are working because that's the only way we can communicate. Normally, we do these live sessions on different topics every week. And the idea of this session is to provide more and more information to the investors of what is going on in the market, what is the expectation, short term, long term, and there are different topics we try to work on. And all these sessions are recorded. You can go to YouTube and check our recordings as well. The point of having a live session is a lot of investors sometimes they have questions and they want to ask live using the chat, and we'll try to answer these questions while we are in the session, or post the session we can definitely reach you out and answer these questions. So if you can hear me properly, if you can see my presentation, just use your chat option to write yes or okay, and I can proceed with my session. And there will be a bit of the interaction also we can do using these chat options. So if you can see me properly, if you can hear me properly, if you can see my presentation, if you have your notepads ready, you can just write okay or yes, and I can start the session for today. Okay, perfect. Great. Okay. Right. Perfect. Okay. So I got majority of people writing yes, so I'm assuming that everything is properly audible. Just in case, if you miss out on the session, you can go back to YouTube and later on check the recording for the session, or just talk to your relationship managers, and you can even have a one-on-one meeting and one-on-one session with us. And we are located in Emar Square, so you can come anytime and we can definitely have a chat with you. So 2022, without without a doubt, we saw a lot happening in 2022. I'll just give you a small brief, a small statistics how 2022 went. We saw a lot of things happening, including Russia-Ukraine war. We saw pound falling down a lot. We saw UK Prime Minister resigned and a new Prime Minister came. And we saw stock markets melting. We saw equity stocks, especially the technology stocks, fell down a lot. Most of the indices have fell down a lot, and it was not an ideal year for stocks. And we saw inflation hitting 40 years high. We saw central bank of US raising rates, and that has somehow made bonds investment, which you can look into. And we're going to talk all about it. We're going to understand what are the risks we have to see in 2023? What are a few themes which are still valid in 2023 to look in? What is the sector outlook like? We'll see each specific sector of equities, that how you can, what is the view on the specific sector? And we'll also understand regional outlook, how every region is expected to perform in 2023. Needless to say, these kind of predictions, or you can say more and more assumptions, are done on the basis of the current market news and a whole lot of research which we do. If you want to invest, please talk to your risk managers first, understand your risk appetite, and only then. This is just an informative session, and we are going to talk a lot about outlooks, but at the end of the day, it depends each and every single day how market works. So today, if you see, we have seen stock markets today after the inflation data came out. We saw a slight increase, but then Dow Jones was down by 29 points. We saw S&P 500 down by 0.1%, not really too relevant. NASDAQ 0.2% lower. But then most of the indices, they swung between gains and losses after the CPI data came out. The CPI data is the inflation data, basically. And what's going on is that the analysts, they are looking very closely at the inflation data. This time it has come around 6.5%. In November, it was 7.1%. And this is another result which shows that the inflation is cooling down. It just hit 9%, which was the peak. It was in the middle of the last year. And right now, coming to 6.5, it is giving a lot of signals. Will central bank pause the rate hike? Will central bank reach to a pivot point where they stop raising the rates? What impact it will have on the stocks? What impact it will have on the bonds? And is it a good news for stock investors that inflation has shown signs of cooling? Now, markets they become very optimistic the moment these kind of news comes. But then we have to look at a long-term trend, and we have to evaluate the risk, what the session is about, that what are the risks we are looking at 2023 before we start investing anywhere else. So just to share you a small statistics for what I was looking at, how 2022 worked out. I'm going to show you few stocks which fell down along with the indices and the percentage. And these results are as of 28th December, the performance which was checked throughout the year until 28th December. So I hope everybody can see this. Yeah. So this is the year till date performance for 2022 for these stocks. And by the logo, I'm sure all of you can recognize these are pretty big names. Back in 2020 and 2021, these names gained a lot of percentage in prices, and it became sort of favorite for the investors. But now look at them, how 2022 has gone for these stocks, and what is the percentage price they have fallen down with, and how many stocks, if I see, majority of them are from technology sector. And if you see Tesla down by almost 68%, uh, Facebook or Meta down by 66%, PayPal down by 64%, Netflix down by 54%. Then we have Expedia, 54%, then Nvidia, 52%, Amazon, 51%. Amazon also went through a stock split. So the stock, which was $3,000 before, right now is around 89 or $90 per share. Salesforce down by 49%, which is a software as a service sector stock. Then we saw Walt Disney going down by 46%, Adobe 42%, Google 41%. Stocks like Nike, Microsoft down 30%. Apple is down by almost 30%, followed by Bank of America 26%. And then something we saw, Carnival Corporation 62% down, Intel 50% down, FedEx 33% down. And then there were some other asset classes like indices, for example. S&P 500 went down by 21%. NASDAQ, which is a tech-heavy index, we saw NASDAQ going down by 35%. So NASDAQ tracks around 100, the performance of around 100 stocks. And a lot of them are into technology and biotech. And we saw NASDAQ going down by 35%. German index has gone down by 12%. And then amongst treasuries, we saw T-bond, treasury bond ultra down by 32%. Currencies, amongst currencies, Japanese yen 14% down. Euro also fell a lot, and now we have seen a slight recovery in euro. And then there was crypto. The world of crypto is completely shaken. I'm sure a lot of you have seen cryptocurrencies back in 2020, how they went up, and now we have seen cryptocurrencies coming down. Ethereum in specific has gone down by 68%. So this was something which we saw in 2022 along with the major events. And this is really important because at the end of the day, when we go back and start looking how exactly 2023 is going to be, it's going to depend on whether inflation peaks out. It's going to depend on whether central bank is going to continue to increase interest rates, and all of them. Somebody just asked, the inflation numbers, are they pertaining to India? No, we are talking about inflation numbers as in US inflation. We are talking about Central Bank of US Federal Reserve raising rates. US becomes a kind of center of attraction because um, the depth in the market, largest stocks, when we talk about Amazon, Alphabet, Microsoft, by market cap, these all are US stocks. Even UK has the largest bond market, but the volumes are much more in US. So as of now, when we are talking about inflation, we are talking vis-a-vis US markets. So let's just make that clear. Now, uh, understanding the top global risk of 2023, and again, we have put it as the top five risks, but then at the end of the day, I'm sure um, the markets will not stop surprising us. But then, as we see now, these are few risks which we have to keep a check, because in 2020 economies around the world were worse than anyone had forecasted. In 2021, a lot of countries, they saw very surprising rapid recovery. And this is what reminds us that the risk of surprises, it's not always to the downside. We can be surprised on the upside also. Maybe today we are talking about stocks may not be a good idea, but who knows that the buy at the end of the year, few stocks that just starts going up. So when I say the risk of surprises is not always to the downside, it's possible. Probably we might see a few positive days for the stocks, and those positive days might really surprise us. So we have to see how the stocks have performed in 2022. There, and as I showed you the statistics of a lot of these stocks, which are down by almost 50%, 60%, and sometimes the market prices this negativity, and investors starts entering into the stocks, and that creates a momentum. Today, for example, a lot of investors, when they see Amazon down by 50%, they're inclined to buy it because it's a $1 trillion company. So there are a lot of long-term investors, and there are a lot of short-term investors. You as an investor has to see that what's your outlook like, and what you're looking at, right? India position. Okay, okay, perfect. So please keep writing down your questions. I see that there are a few questions coming in, and we'll try to answer while we are doing the session, or by the end of the session, we'll definitely be ready to answer these questions, right? Now, understanding the riskier part. So China's reopening, we saw that how China was very strict with its COVID policy measures, and then a few weeks back, they actually surprised everyone. Within a few hours, they removed all the restrictions, and now it seems like China is reopening. And as much as it seems like a great news, but then, as I said, China's reopening, it could reopen at a surprisingly rapid pace. And we have seen this because over the past month, if you compare all other countries and look at the reopening experiences and how the economic growth has fueled, China could be really, really fast. And when that happens, there is a possibility of a accelerated economic growth, and that will happen. When that happens, we'll see a lot of investors buying stuff, and that could actually lead to rising inflation, because when China reopens, and it reopens at a rapid pace, there could be a lot of consumer spending, and that might again lead to a rising inflation. And I feel that it's not really unreasonable to expect this, because there is a lot of pent up spending among the Chinese investors as well. Even for the investors who are sitting here, they have been looking at the Chinese stocks really closely. We have seen a lot of Chinese stocks coming down. So I would not be surprised if people start buying Chinese stocks also. And again, we are looking at a 1.4 billion consumers after a year of restriction, when they have this excess cash deposit. And in China, there is one more thing which has been going on. While the central banks around the world have raised, sorry, while they have raised the interest rates, we have seen China mortgage rates falling down. Now, this is where we have to see. So the chart which I'm sharing with you right now, one second, yeah, right here. If you see that the consumer excess savings have gone up, and we have seen the mortgage rates, which is marked with orange, the mortgage rates in China, they have been going down. And this is something which is really important because we have to understand how China reopening will be uh, taken or considered, because the timing of this China sales exposure, how they are one of the biggest buyers for commodities and goods. And when that starts, if it continues to rise up inflation across the world, while central banks are already talking about increasing rates and trying to control inflation, if that happens and China goes all in, we might see not a very ideal time, because this surge of consumer spending could come around early 2023 as we are talking. And this is the exact point where central banks are trying to control inflation. They're trying to pause the rate hikes. So um, this is one risk which we have to keep in check. And as I said, China is one of the biggest buyers for commodities, largest one of the largest importers for commodities like gold, and even a lot of people have excess cash and a year of restrictions, and it's one of the biggest market. So when the consumer spending increases in China with low mortgage rates, we might see an influx of inflation, and that is one of the important risks which we have to keep in mind. And followed by, as I said, the second point, central banks over tighten. Now, I'm just showing you a chart over here, and just to simplify the whole thing, central banks, lot of, I think most of the central banks, we have seen analysts and other investors, they could have priced in this expectation that central banks are at the end of the rate hike. So 2022, central banks increased the rates. Now they're very close to 5%. And for those investors who are not very much into the financial markets, increasing the interest rates, when I say that, means increasing the lending rates. So, for example, if you need a loan for your house, earlier you might have to pay 1% interest, but now it's 4%. And if it continues to increase, again, it reduces the economic activity across the world because credit becomes expensive and thereby reduces the consumer spending, which controls the rising prices. That's why central bank increases the rate. And when we say that central bank is tightening the monetary policy, that means they are increasing the rates at a faster pace and to control the inflation, which is already very high. So 2022, we saw central bank of US specifically increasing the rates to control the inflation. And initially, before the beginning of the year, outlook from every analyst was that, the rate at which they have increased the rates, probably in the mid of 2023 or by the end of 2023, will be able to control inflation and central bank will end this rate hike. Now, the point is, as much as it is expected, there are still major central banks across the world which are making it very clear that they are not finished. Uh, Even after raising rates at this pace, they are still not done. So we have another 75 pips interest rate coming from Federal Reserve Chairperson, and all this will depend on how the labor market works. If unemployment in US increases or the private jobs report does not come as it is expected, or any economic indicator which shows that there is a weakening, if that happens, then rates may not increase. But then from last few weeks, labor market looks stronger, unemployment rate looks stronger, and unless any of those factor weakens, we might see central bank continuing interest rates. And again, as I say, that this US is not done yet, and Europe Central Bank, for example, initially in 2022, they softened their approach. They did not increase rates by too much or with their targets. But then this year, even European Central Bank also might increase the rates. So when we are looking at major central banks, if all of these central banks they continue to raise rates and tighten up the monetary policy, that is a big problem, because when I say over tightening, that means central bank rates in 2020 were extremely low. In 2021 started going higher, and 2022 they notched up way high. So when you keep the interest rates low for too long and then increase it too fast, that presents a downside risk to the market's expectation, and that sometimes it disturbs economic activity, and that's what causes recession in major economies. So I'm sure many of you must have heard about how economies like US and UK and Europe, they are brinking into recession. Maybe US less, but then when we talk about UK and Europe, the recession risks are too high. So we have to be very careful of these economies and what's going on with the central banks. This is the time, friends, we have to keep ourselves very much updated with what's going on, because a lot of investors, they leave things to their fund managers, and I understand that. Obviously, a lot of us have very little time, and sometimes we are busy in our own stuff. But then this is the time when you have to be closely watching your investments. You have to be closely watching the financial markets, interest rate decisions, and be very much updated about what's going on. So China reopening, central bank over tighten, and then again we have Ukraine war issue, which is another major issue, because as of now markets have kind of priced the Ukraine war, and the expectation this year was that the intensity of the Ukraine war might be towards more of a negotiation. It might end the military hostilities, might limit the risk of the re-escalation. But then again, the path which Ukraine has to follow to end this entire fighting, they first have to reclaim Crimea after Russia's seizure in 2014. And whatever move they do to retake this territory, again, that could not be suitable to Russia's President Putin. Now, that could risk again the escalation of troops by Russia. And when something like this happens in a larger scale, civilian infrastructure gets impacted, and then shipping routes get impacted, and again the supply constraints come in. If you see in 2022, because of the supply issues, we saw commodity prices going really, really high, and that is a big problem. So unless Russia Ukraine war actually softens up or a negotiation happens, military hostilities end, will always have this year hanging on us, and we have to be very much updated about what comes next in the Russia Ukraine issue. So that is something which we have to keep a check on. And then we're talking about mortgage shock and European energy crisis. So let's understand what the mortgage shock is, what we are talking about. Now, as I said, that when central bank increases the rates, it increases the lending rates, basically credit. You take a loan to buy a house, you take a loan to get a car, and now that credit is expensive. Basically, it has skyrocketed this year. Like if you see in US, the mortgage rates are now around 5.5%. And in the beginning of the year 2022, it was 2.7%. So as you see, that it has almost doubled. And as of now, we have to understand this. If the recession, and as we see what people are talking about, if there's a potential global recession, and if it comes very close to the major economies, and if unemployment rate slightly starts going up, then there is a problem, because decline in home prices again might raise defaults, because a lot of people have already taken mortgage and there are no new houses which are being bought at the particular moment. So there are few countries which are here, which are looking at a major mortgage shock, and there is a significantly greater risk in countries like UK. Then there is Norway, and then you see New Zealand. Some risk in Australia, Sweden, Canada. If we compare US and these economies, more risk in Canada and Sweden and Australia than in US or France or Germany or Italy for that matter. So you see the major real estate or major mortgage shock countries at this moment is probably UK, Norway, and New Zealand. And we have to be very careful about that as well. And again, as I said, it depends on country to country. If interest rate continues to go higher, the chances of a recession are likely, right? Because the mortgage shock will be much more higher in these countries if the interest rate continues to go high. So this is also something which we have to be very careful about. Um, Another very important thing which we saw in 2022 was European energy crisis. Yes, and then European energy crisis, it led natural gas prices go really up. And if you have seen last few numbers for natural gas, it just went up. And even now, also, if we see the tension in European energy market, it still continues to loom large because Russia has suspended natural gas flows through the Nord Stream gas pipeline, and this has now been forever. And the European import ban has happened. If you see, there have been price cap on Russian oil. This has been implemented already. Now, the whole point is Europe's gas situation is still very fragile because the winters are really cold, and that could increase the consumption of gas. And the availability of gas is very less, right? And even if they have to export it from US, it's still the consumption is too high, and the availability of gas exports what Europe get from US, it's still very less. So that could not only just shut down Europe's industrial business, but also the automotive business. And that's why European economy is going to be very fragile this year. And if the energy crisis continues, then we have to be very careful about picking our investments in the European sector. So these are few areas of risk which we have to evaluate, we have to understand, and we have to consider these risks into our portfolio. Now let's have a look at the sector-wise outlook. Will So every equity market has different sector. Today, if I talk about Coca-Cola, it comes into food and beverages or consumer staple products. Then we talk about luxury products, it comes into consumer discretionary. We talk about pharma, medicine, that comes into healthcare. So if we see the sector-wise outlook, what 2023 is expected, and that's again really important because in 2023 we have to see every single sector. If you see, for example, healthcare. Now, healthcare has been the most important defensive sector, and the valuations of the companies in the healthcare sector, I'm talking about US healthcare sector to be very specific. If you see for 2023, the valuations are still looking very much better. And this is something which we have to understand. As I talk about the US healthcare sector, we don't have to neglect the emerging markets also. So the healthcare sector in emerging market is also really important. It is still a very preferred sector in the defensive stock. So today, for example, if you have to buy stocks, avoid too much volatility in your portfolio. Go with something which is less fluctuating, less volatile, and can give you a dividend as well. So within healthcare, I'm talking about healthcare equipment companies because in 2023, the healthcare equipment sector is expected to drive growth, and that is something which you have to understand because healthcare sector is a very so though for those investors who are looking for long-term growth drivers, look for emerging markets. All the healthcare companies in the emerging markets, that is something which you can very much focus on because emerging markets have a lot of people in terms of aging population. Plus, emerging markets still have a lot of development of new technology. So vaccines are being still developed. We saw, we learned about the Omicron variant of lately being talked a lot in US as of now. A lot of people are wearing masks during their flights because the Omicron variant is at large. And in emerging markets, apart from US, we see that there is a high statistics of aging population which needs more and more care. So healthcare stocks, which are very less volatile, it gives you a dividend also. And in emerging markets are something which you could prefer in your portfolio if you are looking for equities. Because this year, every analyst is just talking about bonds, fixed income. Interest rates are already high, and if central bank stops raising rates, we'll see bond prices finally start moving, equity prices coming down, and then probably you can enter into stocks. But then, if you are an investor who only likes to buy stocks, look for less adventure in your portfolio with healthcare and emerging market stocks, or healthcare sector in the emerging market. That is also something which you can look at. Now, from energy point of view, for 2023 is going to be again very challenging for energy. And energy, by means, when I say energy, I'm talking about oil, I'm talking about natural gas. In 2022, we saw energy was at a very bright spot. uh, 2023 is going to be very, very more challenging. And within energy, I would suggest, so sometimes a lot of analysts, they just tell you that, okay, be away from energy, be away from this sector. But what we have to closely understand is, within every sector there are a lot of subsectors. Like within energy, there are oil companies, or there are energy based companies, for example, which are into exploration and production of oil, right? And then there are those companies which are into equipment and services, which normally, for example, as I say, the equipment and services companies of based in energy sector are still better, because at the end of the day, if a company is used for extracting or refining activities of oil, is still at a better position than the companies which are into exploration and production. Because if the production of the oil is expected to go down due to recession or due to a market slump or whatsoever, but whatever oil is produced or explored, the extraction and refining will still continue, right? So the idea behind energy is that if you want to invest into energy stocks, we have to say, uh, and we have to understand that the production and exploration companies related to fuel can be avoided. But then those companies which are into equipments and services, which means when the oil is produced, the extraction and refining of oil, those companies which are used for that, that could be a promising idea. There's a question: when you say healthcare companies in emerging markets for 2023, are you talking about clinical services like thyrocare or hospitals? I am majorly focusing on healthcare equipment companies. A very good question again. So when we say healthcare, are we talking about hospitals? Are we talking about a specific part of it? Within healthcare, again, in emerging markets also, if a specific sector which is related to healthcare, so there are a lot of companies, like in US, there are companies like Boston Scientific, for example. They create these healthcare equipments, new medical technology tools, and companies which are involved into development of vaccines of different kinds of diseases. Those kind of companies could still be a good idea. So basically, and there is a whole list of healthcare equipment companies which you can look at, right? So, followed by another sector, which is communication services. Now, communication, without a doubt, has been the worst performing sector in 2022. And as we see, if there is a further slowdown, because if and let's we are just taking the worst of everything. I mean, we should be open to all possibilities at this moment. So when we see if there is a recession coming in, or central bank continues to raise rates and economic activity slows down, and if we see another year of how we saw 2022, if something like that happens also, we see that the advertising, because products are not marketed well, because everybody is just trying to save cost, and in those terms the advertising revenue also falls. So when I am talking about the communication services sector, in 2022 this sector did not perform well, because advertising revenues were slowed down. And again, because stocks fell down a lot, uh, the valuations of these companies now have become better. They are not overvalued, they are not very expensive, and they're expected to grow twice as fast as if we see the broader equities. And even we have seen back in the past that media and entertainment is one of those sectors which has the highest growth potential. So within communication services, I think if you can list down some telecom companies which are cheap and which have an attractive dividend yield, I think that can suit your portfolio. Again, guys, I'm saying this if you are employing equities in your portfolio, if you're putting stocks in your portfolio, then this is one sector. Within communication services, you can see some cheap telecom companies, stocks which have gone down a lot in 2022, still have a very attractive dividend yield, could be your choice. And as I say, this is some information which I'm giving you on the basis of research we do. But before you invest anywhere, always check your risk appetite, talk to your financial consultants, talk to your risk managers, and only then proceed. But then this gives you one perspective, right? That if I have to invest into a sector, what subsector I should look into. Should I just go for media and entertainment, or should I just look into cheaper companies related to telecom, which move less, not very volatile, and give you a fixed dividend also, right? Because at the end of the day, these are stocks and there are valuations. Maybe something in 2021 was too expensive, but because of the continuous decline, the stocks have now become cheaper, or some of these companies have become cheaper and reasonable to buy, right? Now, another sector which we are closely looking at, consumer discretionary, because this is consumer discretionary is luxury. We are talking about high-end consumers, right? Um, Now, this sector is really important. Why? Because your first important question is that if you're talking about luxury stocks, and if a recession comes in, then why people would buy luxury stocks? Now, every decision or every investment decision which you will take should also have the inflation factor in your mind. Now, consumer discretionary, or when we say these high-end companies or the segments which are exposed to the premium consumers, and I'm talking about luxury goods, they expect you to do well in 2023 because these companies have a very high margin resiliency. They have good pricing power, and that could be a very supportive factor. And why I'm talking about this, first of all, I spoke about the reopening of the Chinese economy, right? So a lot of investors, a lot of consumers in China, they are one of the biggest buyers of the luxury products. Second thing is the luxury products, as I said, have high margin resiliency, high pricing power. So what does that mean? That means that when inflation goes up, a lot of companies, they are not able to pass the rising cost of their raw materials to the consumer. In fact, what they do is, so for that, because they cannot pass it on the consumers, they cut down their profitability ratio, they cut down their profit margins. But with high end luxury companies, for them it's easier. When the prices go up or when the inflation kicks in and the raw material prices go up, they can easily pass that cost to the consumer and keep their profit margins intact. That is one of the significant reasons, because we are into a very high inflationary environment these days. And if you're looking at the stock, then probably consumer discretionary is one sector. The luxury goods are one sector which have a high margin resiliency. They can pass on to the rising inflation cost to the consumer and protect their profit margin. So that is not going to reduce their profitability, right? So that is again one thing which you can keep a close watch in. Uh, Few other sectors we are looking, consumer staples, for example. Now, consumer staples, these are your necessities, right? Uh, Within consumer staples, so I'm talking about companies like Johnson and Johnson, Procter and Gamble. Um, when I say in this particular sector, we have to be very careful, but then we have to pick high quality names. Consumer staples have always been the favorite. So whenever recession come, there is a possibility of a recession, people start investing into consumer staples because these are defensive stocks. And historically, we have seen whenever the bond yields go high, investors, they prefer to put their money into defensive sectors. Also, defensive sector means something which they call it recession proof. Whether there's a recession or not, you're still going to buy food products, right? And these kind of companies have really good dividends also. So now, in this case, we have to see which companies are high quality companies, because this is a year where when you are picking a stock, you should stick to high quality stock. Um less leveraged companies, those companies which have less debt, is better. Those companies which are more margin resilient, as I said, those companies which are able to pass on to the inflation cost or rising cost of products to the consumer and protect their profit margins, is what you have to see. So within consumer staples also, you have to really pick out those companies which are good quality, less leveraged companies and high margin resilience, high pricing power, and that is what will be important. Now, a few of other sectors we are looking at financials also. Given the interest rates have been going up, there have been a lot of financial stocks which have benefited significantly because interest rates have gone up. The interest income for these financial sectors have been really good, and I'm talking about banks, I'm talking about companies like JP Morgan or Bank of America for that matter. But then again, if global growth slows down or if there's a recession risk, then we have to balance it properly. Because what happens is, at this point of time, financials are really good. And when I say financials, I'm talking about a lot of these financial stocks. Earlier, what used to happen was the financial, and we have seen 2008, we have seen 2001. Every single time when recession kicks in, the financial companies, they're very vulnerable, right? And as of now, because post 2008, there have been a lot of stress tests, there have been a lot of practices and regulations. So now the financial sector is much more in a better condition to absorb those shocks. So if even if there is a point where the recession is looming in, if we stick to good quality financial companies, because now the financial companies or the banks, they have enough capital to support this stress, and it's not like before. So going 2023, stick to the good financial companies because it's a high interest rate environment, and the interest income of a lot of these financial companies have actually gone better. And unlike in the past, these companies are now much more stronger and much more capable to absorb or fight the stress of recession, right? And then there are sectors like industrials and utilities. Now, industrials is one sector which you have to be very careful of, because when we are looking at industrials, this is very sensitive, because industrial sector is all about manufacturing, it's about industrial production, right? So if recession risk, if it starts looming larger, then we have to see that this is one of the important sector which is very sensitive, and if economic activity reduces, then we might see the industrial sector going down. Now, there is already a lot of talk about so let's say, even in industrials, as I say, that every sector has a subsector, and let's say transportation, for example, comes into industrial, capital goods comes into industrial, right? So transportation with a slowing global growth, we have already seen how FedEx stocks have come down, right? So transportation sector within industrial, not really a good idea to invest into. But then if we see the Russia-Ukraine war escalates, or if geopolitical tensions they escalate, then within industrials, the aerospace sector could get a lot of benefit. Now, again, as I said, guys, the sector as an industrial is not a good idea, probably if we are expecting a slow global growth or recession fears. But within industrials, manufacturing or infrastructure companies or transportation companies or capital expenditure based companies may not be a good idea to invest in. But then since we are talking about rising war situations or a possibility of the re-escalation of Russia over Ukraine, aerospace companies could be one sector if you are looking to invest into within the industrial part, right? So that is something which you have to be very smart about. Utilities, as I say, 2022 we saw utilities was one sector which was very resilient as compared to other sectors, because the way markets have performed, the tech has gone down a lot, but then utility sector has still performed well, as it continues to be one of the most defensive. And when I say utilities, I'm talking about companies which are into the basic necessities. Electricity, right? For example, is one of those sectors. So you still need electricity, you're still paying your electricity bills, and there are a lot of these companies which are into utilities, which are into daily necessities. Now, in 2023, also this sector is expected to remain favorable. As we talk, if there is a recession risk and if it intensifies, also we expect utility sector to hold their ground. Earnings are expected to be resilient. Now, because this stock has not come down, this sector has not come down a lot in 2022. Going forward, 2023, the valuation looks slightly expensive. But then again, this is one of the defensive sectors we have to look in. One very important risk which you have to understand about utilities is we are talking about just 1 second, just for the sake of clarity, can you please confirm that most of your commentary and expectations related to US market only? Yeah, so as of now, when I'm talking to about these sectors, this is mostly about connected to US stocks. We are talking about US stock market at the moment. Next few slides, we'll talk about the regional outlook. What is like how US has performed, how UK has performed, how Middle East has performed. So we'll be talking about the regional outlook as well. The sector outlook is mostly related to US stocks. That's what we'll be further discussing about. So within utilities, one important risk which we have to see that these days there has been a lot of talk, and we are into a Democrat president, Joe Biden. A lot of people are talking about renewable energy and the effort to bring this transformation of renewables over non-renewables. It has been more and more talked about, and people are becoming more and more conscious about this. So when you are investing in utilities, you have to be very careful about the regulations which also apply to the non-renewable sources. I'm talking about coal companies, electricity companies, power-based companies, right? So if there are strict regulations coming in for the transformation of non-renewables over renewables, then those investments might get impacted. So be very careful. And this is a very big topic when we get into the whole sustainability point of view, because a lot of pension funds, they invest that money into utility sector because it's one of the defensive sector, gives you dividends, right? But even those portfolios now should consider the risk of transformation. If the regulations comes in and there is a rapid transformation of non-renewables to renewables, renewables to non-renewables, then this sector might suffer. But until then, as I said, that stick to the quality names, and I think that is something which is really important. But then this particular sector has done really well in 2022, and in 2023 going forward, you can always allocate a part of your portfolio to these sectors as well. Now, following, we see IT and then materials. Now, IT, how many of you have invested in tech stocks in 2022? Just name the stock if you have. I mean, I don't want to know the details, how much amount and anything, but which stock, if you have bought any technology stock, whether US or India or around the world, any tech stock. Okay, I started getting answers now. All right. A lot of you have not, which is a very good thing. Okay, 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 okay. Nice. Okay, good. Okay, all right. Okay. A few of you have put in Tesla also. Tesla is another story. I think this is something which a lot of us thought would work, but then Tesla has been going down. Okay, all right. Infosys, Tech, Mahindra. Okay, perfect. See, those who have invested in Indian tech stocks, still okay, because India is the exporter of, they basically outsource technology. So that's still okay. But the US tech has been falling down a lot. So I think that is one thing which has happened with the technology companies. Now going forward, we are still in a very high interest rate environment. So whenever the interest rates are high, tech sector gets impacted first, and we have to consider this because 2022 tech stocks very highly sensitive to the rising yields, right? So central bank still continues to raise rates. What we have to clearly understand is within the tech, uh, apart from the bigger names, what you can do is be much more connected to the area which is related to software as a service. Now, software as a service are these bunch of companies. Like when I'm talking about software as a service, it's a subsector in technology. And within technology, when you use software as a service, I'm talking about all those companies which are related to cloud computing or which are related to CRM or CRM companies like Salesforce, for example, right? So a lot of these companies are there which are still needed. Apart from Microsoft or Google or anyone, the bigger names, there are a lot of individual companies which are involved into providing services to the cloud areas. So, for example, a lot of people still use Salesforce. The stock price has come down, but then if I had to invest into tech and take advantage of the falling prices, I would still stick to companies like Salesforce.com or any other software as a service company, right? And I'm talking about all those areas, all those companies which are into cloud computing or web hosting services. That is one area. Cybersecurity, for example, is one of those areas. So we'll also learn about the trends which are coming in, right? So that is something which we'll definitely look. Materials, last sector which we can discuss about. Um, we saw material stocks resisted really well in early 2022, but then eventually there was a massive sell-off. And this is a very cyclical sector. In 2023, the pressure is going to only intensify. Again, there is a lot of companies which are into manufacturing, metals, mining, and this is something which is really important. Housing and infrastructure spendings are actually cut back. So this is one sector again in 2023. This sector might face a lot of problems. So be away from the materials sector. With interest rates high or with global slowdown coming in, there's a possibility that manufacturing and infrastructure and all of these areas might reduce or there is a contraction. So be away from the materials sector. Try to look more towards utilities. Within IT, pick companies like software as a service. Within energy, try to pick companies which are more into the process based, right? Equipment and service based companies. Look into the consumer discretionary, as they can absorb inflation really well. Within communication, you can look into telecom companies which have good attractive yields, dividend yields. With healthcare, you can look into healthcare equipment companies in emerging markets. So these are few things which you can keep a check, but again, talk to your risk managers as well. Before we move in, away from this section, there was a question. Where do you see the impact of China opening on the future of Indian stocks in sectors like metals, specialty chemicals? So again, good question, because obviously we have seen Indian stocks actually rising. And I'm talking about the metal-based stocks also. There's a lot of optimism in India for the China reopening, and even in Indian shares. Like last week, we saw that Indian equities have actually extended gains, and there was a big jump in the metal stocks because there was a huge boost up in the risk appetite of the investors when China announced that they are losing up the COVID-19 restrictions. We saw Nifty going up, we saw Sensex also going higher. And then if we see the metal areas, the sectoral gains, it almost went up by 4%. Now, there are a lot of top metals consumer, like for example, China. It's one of the highest metal consumer. And again, since China has announced that they will stop this quarantine and everything, we and zero COVID policy comes in. I think this is one of the best things for countries like India, because the domestic infrastructure in India, the spending, it could improve. Metal companies, again, if China, I'll show you further in the presentation that how demand for gold actually slowed, like it got reduced. A lot of demand for commodities reduced because China was under the lockdown. So all of those now demands can be revived, and that is something which is really, really good for India. Even like when I see Japanese equities, or the volatility when we see in Indian markets, it has been better. A lot of if you see stocks like Hindalco Industries, for example, or Tata Steel also, or JSW Steel also, all those stocks have went up around, I think, at least 3 to 4%. So I think it's good for India. The China reopens. I think from a broader perspective, the only thing is, the key thing which you should see is the inflation part, because excess consumer spending, if it starts increasing inflation again, as I highlighted in the risk, that might impact or trigger central banks to again increase the interest rates, and that might bring the stocks down. So that's the only risk which you have to keep a check on, and I think that's really important, right? That's great, guys. Please continue writing more and more questions. I think we are just halfway through this. And for the regional outlook, as I said, because we are talking about now how the regions have performed and which are the regions which we have to be very careful about, because there are these areas. A lot of people are asking whether we should invest in UK, whether we should, invest into Europe or US. Now, if we start, let's focus more on Europe at the moment, since we have talked a lot about US. The energy crisis is going to dominate again, and Eurozone in 2022, if we see, I think last quarter of 2022, it looks like Eurozone already entered into recession. First quarter for Europe will still be a problem, because again, at the end of the day, we have to see that they have not only a gas crisis to the energy crisis to work on, but also their position between Russia and Ukraine. And I think that's one important thing. And Europe has not been increasing interest rates, but they have been facing the inflation a lot, right? So that is also something. You're looking at a high inflation, you're looking at a weaker currency. And if Europe Central Bank starts increasing rates aggressively by 2023, then we might see the equities also coming down. So as of now, European equities is something which a lot of investors are away from. So just maintain that. For UK also, I think there's an impending recession which you should keep a check on, because for UK we saw pound went down a lot, and again third quarter of 2022, UK entered a recession, and the first half of 2023 it is expected that UK will continue to be in recession until it peaks out, right? So again, we have to be very careful, in rather than picking on UK equities or European equities, try to stick with quality names in US or in other emerging markets, as I said. And when you see other economies like Switzerland, for example, I have mentioned Swiss also over here, if you see right here, because very few people look at these kind of economies also. And Switzerland has kind of the economic growth has been slower, but then it is expected that Swiss economy might avoid recession, because their private consumption of goods is still very solid. Unemployment rate has gone down to the lowest level in 20 years. Consumers in Swiss, they're still in the mood for spending. There is a lot of job security, and again, as we see that the energy prices, when they increased, we saw that the prices increased, but because the Swiss currency also became stronger, so it got limited. And then inflation in Switzerland, it is much lower than anywhere else. So in 2023, I think it's one of those areas where you can look into. And again, they might increase their interest rates also, but then that increase in rates will be much less than what we are talking about in US or UK and Europe. So that is again, guys, you can look at something. Right. So Japan, Asia, Latin America, and then most important thing, East Europe, Middle East, and Africa. So Middle East and Africa, GCC economies or GCC economies have outperformed a lot of economies. I'm talking about a lot of even within Middle East. If we talk about UAE market, um, of lately, His Highness Sheikh Mohammed launched an agenda under D33 where they are bringing a lot of the attempt is to bring a lot of foreign investments in the economy. We have seen that there has been this pipeline of IPOs which happened, Diva, Salik, and a lot of these companies now, and a lot of other companies in UAE now, they are not. They're basically bringing a lot more efforts to restrict this foreign ownership restrictions, because now companies are very much open. They don't mind bringing foreign investors, even if the foreign ownership is 100%. They don't mind. In fact, this is one of the agenda of D33 to bring more and more foreign investors. Road shows are happening in New York, specifically by UAE, to talk about to have one-on-one discussion with the biggest fund managers. Within DIFC, there has been around 500 companies which have registered. So when we see GCC markets or UAE markets, now they're very much opening up to the foreign world. And I think this is one of the important areas we can diversify into. Within these roadshows, companies like Diva and Salik and all of these companies, Imar, Aramix, and all of these companies, they're having one-on-one discussions to attract more and more foreign investments in their companies. So within GCC market also, we have to be very, very careful, and we can diversify into these stocks as well. And at the end of the day, there is good dividend coming in. Within Asia, I already talked a lot about China. India, again, same thing. There has been an influx of foreign investments. The withdrawal rate is very less. And within India, a larger amount of volumes have been generated by the youngsters. Every single person now wants to invest in stock market, so that has huge volumes. Plus the foreign investments in India has continued to grow. It is expected to grow this year as well, and the withdrawals of those foreign investors have been very less. So we are looking at India also as a very promising market you can look into. Right now, coming in, before we end the session, we are going to talk about just 5 themes which are going to drive these global markets. And this is again, guys, really important, because at the end of the day, we have to see which are these top 5 themes which will be driving. Talking about inflation, delays a policy pivot as central banks stay the course, recession or no. So that's the important theme which you have to keep a check on. If inflation continues to increase and if it sticks, doesn't go down, will central bank increase further rates or they will stop? If they stop, good news for equities. If they don't, then bad news for equities. Dollar's newfound supremacy will bring pain everywhere else, but a peak could be coming. So dollar became stronger. I'm sure everybody has seen a lot of relative currencies in comparison to dollar, in relation to dollar. They have impacted. They have been impacted, and USD has been growing very strong. Now the point is, somebody said here, dollar index long. I just checked it. Crypto short index long. I think that is one thing. Dollar index, yes. So the way central bank has increased rates, it has made dollar stronger. And if inflation continues to be stronger, rates continue to be higher, dollar might remain strong. But there is another view that if inflation gets into control and if central bank stops raising rates, will that be a peak for dollar? So be very careful with that. Maybe dollar strength has peaked out and might come down. So that is something which also will be in talks. Amid recession concerns, investors mull when to shift from defense to offense. So, as I said, stocks at this point of time, rather than this may not be the right time to just buy stocks away. As of now, bonds is one of the promising area to invest in, right? And as we see further that there are US treasuries which are giving you 4%, and probably until the central bank stops raising the rates, because when central bank stops raising the rates, at that time we will see when the stocks will be a good idea to buy, because as of now people have bought bonds. There are a lot of investors, they are still continue to buying bonds, and this is something which is giving you a fixed income. So bonds is definitely a better investment at this point. But in the next half, if central bank stops raising rates, that will be the time that already fallen equity market will receive this influx of investors starts buying stocks, right? So just wait for the right time, but be ready. Have an investments account for you that when the time comes, you can quickly buy. China market based on the short-term impact of longer-term sea changing policy. Geopolitical forces has seen a shift in investment towards energy and responsible investing. Responsible investing or sustainable investing is one area which is again very huge, but then this theme is going to be there for the longest time, because um, I remember in 2020 the renewable index starts going up. In 2021 again it came down, but then off lately I'm sure a lot of you must have heard about how in 2026 UAE is going to ban disposable plastics and everything. So responsible investing, renewable, sustainable investments, these are the key areas also, and these themes are going to be there for the longest time. Um, One thing, this is something really important. I'm sure a lot of you must have heard about semiconductors and what has happened. There have been a shortages of semiconductors, and that has continued for the longest time. Semiconductors, they basically power all the cloud driven world, right? And they are very, very critical components of almost every electronic device. Every gadget you use, semiconductor is something which you need for daily basis, and it's a very mission critical industry, right? They're getting a lot of attention. They influence almost each and every other segment of the global economy in some fashion, right? If you see, several decades ago, semiconductor was only associated with computers and cell phones. Today, machine learning has come, artificial intelligence has come, and then semiconductor chips, they from your refrigerator to your watches to your cars, everything which you use in terms of a smart watch or a smart device or any smart connected device, semiconductors are there, right? So it's very cyclical in nature. 2019 we saw industry, this entire industry went through a very big downturn, right? And nobody thought it will grow, but now we have seen a tremendous acceleration in these recent years, and that happened partly due to COVID-19. But then a lot of people have switched to electric vehicles, so that was also one important thing. Another very important thing you have to know is, uh, many people don't know this, but then Taiwan, and especially the Taiwan Semiconductor Manufacturing Company, which is called TSMC, it manufactures about 90% of the world's most advanced semiconductors, and then 75% of key related materials, silicon wafers, and all of that. So look into this stock also, and just understand how semiconductors, they have become a very important segment. So if you look, for example, let's say we look at different areas. We look at uh, metaverse, or we look at software as a service, cloud computing, or we look at fintech, we look at digital payments, we look at cyber security, we look at AI or machine learning or autonomous driving. All of that requires semiconductors. So look at semiconductor companies also. This is something which is really, really important, guys. I'm not sure how many of you look at cybersecurity or how many of you look at AI and these kind of stuff, but they are already into our lives, right? Today, a smart device is something which is there. It's not a dream anymore. People are having it. So semiconductors, they have become a very core component, and I think that segment should be valued properly, and you have to keep a check on those stocks also. Worst may be over for fixed income. I think there are a lot of fixed income bonds which you can look at very quickly. If I have to share a couple of fixed income bonds, there are US treasuries which are already giving you a certain amount of yield. I think that is something which I can quickly show you over here. Yeah, just have a look at this. Uh, Liquid wealth and T-bills, and these there are bonds which are available in smaller denomination as low as $1,000, right? You see the maturity, yield to maturity in all of these. One second, I think it did not change. Uh, Very quickly, let me just add this. All right, here. Okay. Right here. Yeah. Hope everybody can see this. So if you see this, the US Treasury, and this is there are bonds with yield to maturity 4.5%, then 4.5%, 4.2%, 4.4%, and all of these bonds, if you see right here, they have a maturity of 2023. So we should be looking at medium term bonds with decent yield, and again, it's virtually zero risk for you, right? Say one of the safest investment vehicles right here. If you see right here, these are ISIN numbers provided. So yield to maturity 4.6%, 4.5%. Treasury bills, for those people who have not understood this, these are short-term US government bonds, right? They basically, the treasury bill investors, they don't get any interest, but an investor who buys the treasury bills basically earns the capital gains instead, right? So you can look at these kind of investments also, and starts with as low as $1,000, and you can look at the ratings of these uh, AAA bonds, AA. Basically, stick to the quality names, and I think that is something which we should always remember. And if you talk to your risk consultants and or any risk managers, they will definitely tell you that the sort of investments you need to do in bonds, and it is available with a lot of platforms, right? So fixed income is one thing which you can look at. Now, if you're a long-term investor, I showed you the sectoral outlook for each and every stock. If you want healthcare, if you want consumer utility or consumer staples, um, a bit in commodity, as I said, that commodity prices, it remains elevated domestic terms because most of the currencies depreciated. So we saw even at the point where oil prices dropped down a bit, but because of the weakness of the currency, we saw a bigger increase in the oil prices in a lot of countries. So on a domestic level, the commodities prices have still gone up. Um, and as I said, in local currencies, because dollar became stronger, local currencies became weaker. So we saw oil and wheat prices going higher in a lot of economies. Oil prices retreat from the June highs. As I said, if there's a global slowdown and the demand for the oil slows down, then there could be a negative impact on the oil prices, but this is expected to remain around $60 to $70. Natural gas, again, depends on the energy crisis, how crucial the winters are going to be. And then, as I said, especially, so this is something which we saw the statistics, there was weak demand in China, and that has weighed on markets, especially on commodities market in 2022. But now China reopening, we might see. So there are a few factors which we have to see. Gold prices, they react to a stronger dollar. If dollar becomes stronger, gold prices normally we have seen come down. In a high interest environment, there will be very less motivation for gold prices to go up. But now with China reopening, physical demand for commodities might increase, and that could push in gold prices higher. But also, what can push in gold prices higher is the recessionary fears, possibility that if inflation gets under control and central bank stops raising rates, that might push gold prices even further higher, right? So we have to see what happens next. And as we see that precious metal prices, they have retreated despite rising inflation and geopolitical tension because of the low physical demand for gold from China. So now with China reopening, there will be a lot of prospects. It will start. Now, what we have to be very prepared about is this. So we have to be prepared about at the end, supply shortages might turn into glitch. So markets, they always tend to look 6 to 12 months ahead, right? So they may soon begin to reflect, and this I'm talking about considering the European energy crisis also. There is a possibility of some shortages that may start to ease, and then there could be a possibility where, in the second half of the year, if China opens and if for example, if China opens, then it's good. If this starts, if there is a high consumer spending, it's good. But at the end of the day, if for the last year we saw a lot of supply shortage, but if the global slowdown continues, then this shortage can turn into glut. And that's where we have to be very, very careful about geopolitical surprises. Invasion of Ukraine by Russia again could prompt world powers to impose new and new sanctions. So that is something which you have to be very careful about. And then there is stagflation. Stagflation means basically central bank continues to raise rates, right? At the same time, inflation goes up and people do not have jobs, or there is very less demand. So that can impact a high trigger, high inflationary issue. So to avoid that, again, as I said, the central bank has raised rates, but they're keeping a very close watch on inflation numbers. And we have to be very careful in 2023. As I said, markets are not difficult to understand, but then we have to be very careful, and we have to be daily checking, and we have to be very aware of what's going on in the markets. Don't leave anything, like don't leave everything on your fund managers. Be involved in your investments. At the end of the day, that's the time you have made all this money and now you're trying to grow this money. So you have to be actively involved in not just in making money, but growing your money also. If you have any other questions, are you available for a one-on-one session? Yes, definitely, I'm available for a one-on-one session. Reach out to your relationship manager, and they can fix a meeting anytime you want. Can we get these PDFs? Yes, you can. We make this for information purposes, and there are a lot of these PDFs and strategies made. So you can talk to your relationship managers again, and they will definitely provide you with a lot more information. What is next? When is going to be the next session? Next session is going to be next week. We do this every week. So if you have any, every week there is a different topic. Sometimes it's focused on specifically strategies. Sometimes it is focused on a global outlook view. Since it's the month of January, we thought it will be fair to give you an outlook for what 2020 is going to look like. But then at the end of the day, we are going to change topics. Sometimes it's on earnings, sometimes it's on strategies, sometimes it's on very specific sectors. So we do this every Wednesdays or every Thursdays, and your RMs will definitely give you information about it. Can you give a session on Indian markets? Definitely, but sometimes the overall investors, they're mostly interested into global markets. But if you need more information on Indian markets, I'm definitely available for a one-on-one session with you. We'll definitely talk about what Indian stocks can be invested into, or again, in the coming week, we can have a session on Indian markets as well. If not as a webinar, then definitely for a one-on-one session. Do not worry about it. Right. So I think this ends the question answer. If you like this session, please go on Google and review us in Century Financial. And we do this session for information purposes. So we like to give more and more information. At the end, I would just want to thank all of you for being here. I can see there's a full attendance for the entire 1.5 hours, and I think all of us have learned something little. And let's continue to build on this outlook. I hope the next 12 months or 11 months are going to be extremely good for your investments, for you personally. And as far as financial markets are concerned, be informed, be updated, talk to your financial consultants, talk to your risk managers, and most and more important, do not get scared, do not get afraid of the markets. With volatility comes opportunity also. Always remember this, right? So we'll see you next time, next week, with a different topic. My name is Yogesh. Thank you so much for your time. I will see you next week. Have a good night.